Hello everyone. Today's topic is commodity trading. So, in this session, we are going to understand what is commodity trading, what are the differences between commodity market and share market, and how to do commodity trading. So, what are commodities? Just like we buy shares, we can also buy commodities. But commodities, we have to do the derivative trading. Uh, like we buy shares in equity, we cannot buy commodities and hold it for a very long time. So we have to buy in futures. So for all the commodities like rice, wheat, oil, gas, gold, silver, there will be derivative contracts available and you have to buy those contracts of the commodities. So what are the classification of commodities? So commodities can be classified as agri commodities, base metals, precious metals, and energy. Under agri commodities, there comes cotton, cardamom, soya bean, black pepper, sugar, pulses, custard seed, maize, barley. In base metals, there are metals like aluminium, copper, lead, nickel, zinc. In precious metals, there are metals like gold and silver. And in energy, there is crude oil and natural gas. So you can trade in these commodities, all that I have just mentioned. But you have to buy the futures contract, and future contract will be having a time duration. That means it will be having an expiration date. So you have to settle that contract on or before that expiration date. Difference between commodity market and stock market. The commodity market is similar to stock market. So people often try to establish the similarities and the differences between commodity market and stock market. So if we are going to trade in commodities, we must also know the similarities and the differences between commodity market and stock market. Usually those who want to trade in commodities will be those who are already having some experience in the stock market. So what are the differences? On the basis of time duration. In equity, that is in stock market, you can hold a stock for 1 day, for 1 month, or for several years. But in commodities, the duration of the time will be limited. Those futures contract will be having an expiration date. So you have to buy only those future contracts which have an expiration date. You cannot buy in equity or in cash or in delivery, just like you buy in stock market. That you cannot do. The second basis is trading hours. The commodities market will be having substantially more trading hours when compared to stock market. The stock market will be operational from 9:15 in the morning till 3:30 in the afternoon. But the commodity market will be open from 9 in the morning till 11:30 in the night. That is a 14-hour 30-minute duration. That is substantially more than the stock trading hours. On the basis of ownership. In stock market, when you buy a stock, you become a owner of that company. Maybe your portion of ownership is small, but still you are the owner. You will be having the voting right, and also you will get the dividend. That is a part of the profits in the company. But in commodities, you don't become the owner of that commodity. You will not be having any voting right, or you will not be having the right to get the dividends. That is because in commodities, you are not buying in cash or in delivery. You are buying in futures contract. So you are not becoming the owner. We can differentiate the stock market and commodity market on the basis of risk also. Compared to the stock market, commodity market is even more risky. Stock market itself is risky compared to other stable assets like gold or real estate or bonds, but commodity market is even more risky. This is because there will be a whole lot of factors which affect the prices of the commodities, like political unrest, natural disasters, epidemics, climate, etc. These factors affect the supply of the commodities. For example, we can take the example of crude oil. So crude oil is being explored in Saudi Arabia. So if there are any political problems in Saudi Arabia, the supply of crude oil to other international markets will decrease. And when supply reduces, price increases. So the price of crude oil will surge, will increase substantially. So those who have made short selling in crude oil may suffer losses. If you remember, during the COVID-19 duration, the price of crude oil had decreased so much that it had become negative. So those who had long positions in futures in crude oil would have suffered heavy losses. So commodities are so much volatile. So you should be very careful while trading in commodities. So in which commodities people usually trade? People usually trade in crude oil and in gold. So those who trade in gold are usually the gold producing companies, because they will be having a good knowledge about the supply and demand conditions of the gold, which affect the gold prices. That is why gold producing companies usually trade in gold. And petroleum companies are the ones who usually trade in crude oil, because they will be having a good knowledge about the supply and demand conditions of crude oil, and they can predict the prices of crude oil and make some profits. But retail investors also do trade in crude oil and gold. And if you compare to the other commodities, crude oil and gold is the most preferred commodities by the retail investors. Now let us see how the trading in commodities actually take place. And for every commodity there will be a lot size. For example, gold, you have to buy 1 kg. So if 1 kg is the lot size, a trader cannot buy less than 1 kg. He has to buy in the multiples of 1 kg, say 1 kg, 2 kgs, 3 kgs, etc. And to buy one lot of gold, that is 1 kg of gold, the amount almost becomes 4,50,000 rupees, 4,50,000. And for crude oil also there is a lot size, and that lot size is 100 barrels. And to buy 100 barrels of crude oil, you have to pay almost 4,36,000 rupees. So a retail investor might not be having so much of funds, 4.5 lakhs. So how he is able to buy these large positions? The answer is margin trading. Futures, as you know, you don't have to pay the full amount. You will have to pay 20% or 10% of the amount. For example, to buy the gold, you don't have to pay 4,50,000. You have to pay only rupees 40,000, and the other 90% will be paid by the broker himself, and you will be able to buy only by paying rupees 45,000. And this is called as margin trading. Your broker like Zerodha or Angel Broking, those who offer share trading, will be offering commodity trading also, and they will provide you the margin. Let us understand commodity trading with the help of an example. So you are having a fund of rupees 1,000. This is just for the sake of example, so we'll take small amounts. Commodity trading will not be possible in this small amount, for your knowledge. It is just an example. So you are putting money of rupees 1,000, and you will be buying a position of rupees 10,000. That means rupees 9,000 will be paid by the broker, say Angel Broking. And this 10,000 increases in value, that commodity price increases, and it becomes 11,000. So you get a profit of 10%. So 10% of 10,000 is 1,000. But you have invested only 1,000. So your profit is 100%. So through margin trading, you can increase your profits, increase your returns substantially. Let us take another example. So you invest 1,000, your broker invests rupees 9,000. So the total value of the position is rupees 10,000. But let us say the price of the commodity decreases. It becomes 9,000 from 10,000. So your loss is rupees 1,000. You have invested rupees 1,000. So your loss is 100%. You will lose all the money that you have. So this is the risk of margin trading. You might get heavy profits, but you might incur huge losses also. So while concluding, one can say that one has to be very careful in commodity rate trading. To enter the commodity trading, it is preferable to have good experience in the stock market, and that too good experience in derivative trading, that is in futures trading. So the commodity trading also takes place in futures, just like the futures trading in stock market. So it is better to have that experience and then only enter the commodity trading, because the risk and returns are very huge in commodity trading. And if you get it right, you can make heavy profits, but if you go wrong, you can incur huge losses. And also you should be having understanding of the dynamics that affect the price of commodity that you are trading. For example, if you are trading in crude oil, you should be having good knowledge about the factors that affect the price of crude oil. For example, there will be OPEC. OPEC is the organization which controls the crude oil prices. So you must update yourself daily what the OPEC is doing, so how it is affecting the prices, and also the other factors, what is the supply condition, what is the demand condition for crude oil. And only after in-depth study you have to go for commodity trading. Thank you.